Can you hear me?
Yes, sir. Can you hear me?
I can hear you. You are Philip?
Yes, sir.
Hey, Philip, how you doing?
Doing very well. So it looks like I did everything correctly.
I'll be right back.
Yep.
Mask up.
Gentlemen and everybody else, how are y'all?
We're fine.
All right. Philip and Raymond. Raymond, can you hear me?
Yeah, I'm pretty deaf, but I can hear you. I don't have the
All
best
right.
speakers over here. I'm fine.
Perfect. Thank y'all for joining us. Let's see. Looks like we've got about 8 folks on. Welcome, everybody.
Hello.
So I'm going to wait just another minute and then we're going to start. Mm, mm. Mm, mm. Okay. All right, we're going to go ahead and get this kick started. Welcome, everybody. Now, I want to make sure I get the introductions correct. Philip, you and I have not met before. And Philip is our is a CPA. And just introduce yourself if you would. Philip Kuchek. Tell us a little bit about you.
I'm a CPA here in Duluth. We've got an office here in downtown Atlanta also. I've been doing this for about 20 years now. My firm is full service accounting firm. We do bookkeeping, sales tax, payroll tax, everything you can think of accounting wise. And then we do everything tax, whether it's a individual income tax return, partnership, S corp, trust, estates, all, anything tax. So I've been doing that for about 20 years now. A partner here at Wilson Lewis. And I was at Arthur Anderson and Deloitte when I started my career.
Okay, fantastic. So we are glad you're here. Philip is going to give us a broad overview of taxes and what you, just a broad view of how taxes and their I'm trying my best to silence my phone, y'all, hang on. What implications federal taxes, state taxes, income taxes have on investors and investments. And we appreciate that you're here, Philip. If you would, when I stop talking, or as we continue, would you just put your contact information in the chat box for me?
Yeah, absolutely.
Okay. Raymond Kearns. How are we?
With me. I'm good.
Good. So tell us a little bit about yourself, Raymond. Raymond, you are with Campbell and Brannon. Most of us know that, but reintroduce yourself, please.
All right, I'm Raymond Kearns. I'm an attorney at Campbell and Brannon, partner here, and I do primarily real estate and primarily commercial real estate transactional business. So we do a lot of multifamily and shopping centers and just whatever comes across the desk. Done a lot of 1031 course, is part of a lot of the deals, and we do all the ancillary work that goes with that, which is a lot of LLC work, basically. So, we've been doing this a long time. We got a great staff, and look forward to sharing our experience with y'all.
Wonderful. So Raymond is going to be giving us some broad stroke knowledge, and mostly I think is going to entertain some questions. Now, let me just say, this is, y'all, we're flying over real estate from 30,000 feet today. Today is not necessarily stump the expert. This is not, hey, I'm working on this deal, and this is what it looks like, and I found this problem that blah, 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 blah. They would be happy to share with you and talk specifically about a specific deal you're working on outside of this conversation. So with that in mind, Raymond, can you locate the chat box and put your contact information in there for us?
Yeah, I'll figure out how to do that. Should I just send it to you, Clark?
At the bottom of your at the bottom of the screen, if you hover your cursor at the bottom, it should pull up some tabs, and one of those says chat. You see that?
I see participants, chat, share screen, record, and reactions. That's all I've got.
Next to share screen, does it say chat?
Share screen, okay.
Next to that.
I've got that right there.
Does it say chat next to it?
to share.
Oh, yeah, let's not do that.
I don't want to do that.
Oh, sharing screens with you now.
Yeah, let's,
Yeah. Try to get back to where I was. Technology is not my strong point, but learning them during the virus.
I got it. Hang on.
Ah,
Now let me unshare. Hold on. Stop share. Okay, I'll tell you what,
There you go.
when I stop talking, I'm going to share your information in there, so you don't even have to worry about it, Raymond. But let's go ahead and kick this off. So again, y'all, this is we're talking about basics, but I want y'all's information to be in here because, you know, hopefully we can support you in your business. We can bring you more closings. We can bring you. Everybody needs a great CPA. I've been through enough terrible ones to know the value of a good one. So we would love to send y'all some more business. I hope that is something that we accomplished today. Is that fair enough, Philip and Raymond?
Absolutely.
Okay, I'm gonna let you kick it off, Philip. Start us off with kind of how you advise investors.
Okay. Yeah. I'm going to talk like you were saying, very high level tax items, just a few of them actually. And then I'm also going to talk about how I got into investing in real estate and, you know, what it's done for me. And, you know, Larry always liked to say I eat the dog food because I'm a CPA also in y'all's industry, investing in real estate. So I know a little bit about both sides. Some of the real high level items. And before I go any further, please stop and ask questions as we're doing this. It's going to make it way more productive for you and way more interesting for me. So the first item that I want to talk about is short-term versus long-term. You know, anything that you hold over a year is long-term capital gains, which is a much more advantageous tax rate to be in, at least today. There's talk of that changing. So obviously keep an eye on that if you're making that decision, but almost always long-term is going to be better than short-term, regardless of what they do. And then the other thing to think about when you do already own a property or you have a client that owns a property and they're about to sell is recapturing depreciation. That's something that always gets people because they don't understand it. And they don't even know it exists. So when you're depreciating a property, usually over 27.5 years for residential property, when you sell that property, if you've had it for a substantial amount of time, you have to recapture that depreciation. So any depreciation you've taken over a year, 10 years, 15 years gets recaptured, meaning added back to your income. Now, if you're in an income bracket of, you know, say under $150,000, you probably were taking that deduction as you went. So when you come to recapture it, it's really going to hit you hard. If you're in a higher income bracket, well over 150, you probably were not actually getting the benefit of that deduction. And so therefore it was a passive loss going forward. And so they should cancel each other out. So it won't hit you quite as hard. But you need to make sure you realize that. And if you have a client selling that, you know, that's a good point that you can show them that they'd really appreciate before it happens. And then the third thing, which I'm sure all of you have at least heard about, would be the 1031 exchange. It's a great thing to consider. You know, if you have a large gain on a property, at least weigh the pros and cons. You know, if you're weighing the pros today, as opposed to down the road when you think tax rates might be higher, you may want to go ahead and pay the tax now as opposed to do a 1031. But doing that analysis for yourself or for your client can really bring some value. You know, and one of the best things you could possibly do is a 1031 into a final use property. And what I mean by that is a property that you're going to have forever. You know, if you just 1031 into another property and then you 1031 into your final beach house or whatever it is, and you can make that work, and you have that until you pass away and send that on to your heirs, you get a stepped up in basis. So you never pay tax on any of that built-in gain. So, you know, it's not easier said than done, but if you can make that happen, that is a way to kick the can down the road forever. And then the last thing.
Excuse me, real quick.
Yep.
Just reading a comment in the chat box.
Oh yeah.
Rudiger says the depreciation is mandatory, even if you don't have benefit from it, you cannot elect not to take it.
The depreciation is mandatory, even if you don't. That is correct. Yeah, it's and the words that they use is used or usable. So if you used it or didn't use it, that's why, I mean, you might as well take it every single year. You know, I've had clients that weren't taking their depreciation, but when you go to sell it, you still have to recapture it. So I've done the best I could to go back and amend those returns to get the depreciation on there, or, you know, finagle the numbers another way to try not to get them hit so hard when they weren't even taking it. But that is correct, that you do have to recapture depreciation whether you took it or not. Does that answer that question?
Yeah, it wasn't even a question, it was a comment, because that happened to me, you know. I didn't benefit from the depreciation, but I had to recapture the whole amount. So yeah, I know about that.
That's right. And I would have loved to have gotten a little bit creative with that, because that's, you know, I don't like that. I'll put it that way. Yeah. So hopefully you went back and tried to amend something to get a little piece of it if you could.
Yeah.
And then the last thing was when you're selling a property, personal residence versus investment property is a big difference, which most people know. You know, if it's personal residence, you can eliminate up to $500,000 of the gain as a married couple, as opposed to an investment property. So if it's your own personal property and there's any way to get creative with that and call it your personal residence, you know, it takes a little bit of planning ahead. You know, you got to change a couple things prior to selling. Again, that's if it's your own property, and there's even that option. Obviously, if you're buying a duplex or something like that, then that's probably not an option. But it's something to think about, and it's something to throw out to your clients too, if it's even possible. But just keep in mind there is the big exclusion on the individual side for it being your personal residence. And there's some rules that go with that. But most people, if it's your personal residence, and you qualify. So those are the four big things that I just want to point out for tax wise. And then, you know, as far as the investing and me getting involved, I got involved about 10 years ago. And the biggest thing for me was getting started. You know, you've got to get started. The very first one is the absolute hardest to do. First off, you're nervous. The risk, you know, coming up with the down payment, you know, it's just hard to do the very first one. And I just think it's important that you actually get started, because that perfect opportunity, most of them just don't exist. Some of you guys will have something that falls in your lap, but sure, jump on it. But for the most part, you just need to get started, you know, buy what you can afford, and then, you know, keep moving up, you know, you get it paid off, hopefully. You know, money is so cheap right now. If you can get in something, you know, that pays for itself, you know, borrow that money at that extremely low rate. And then as I was going in it, I wanted to dilute my risk. So I got a partner. We set up an LLC, which, you know, obviously became a partnership. So that diluted the risk right there. And then even further from my side, when I diluted my risk, I went towards duplexes. I bought duplexes, and that's what I've done, you know, as much as I could possibly do is duplexes, because you got two doors. If you run into bad times with one door, the other door just about pays for the mortgage. It's real close. So those are the ways that I diluted my risk, you know, which is the biggest barrier to entry getting in these things. And then obviously for me, finding a management company that was trustworthy. You know, as a CPA, I probably see 20 management companies a year, and you wouldn't believe the issues that people have with them. So finding a management company is paramount in the success, you know, because they vet the tenants, they collect the money, they do a lot of stuff, and they have such good contacts with the contractors, stuff that, you know, most of us, me especially, I just don't. You know, the pricing, you're going to save on the pricing just from the contractors. And I know myself and Larry, we use Emerald Management in Lawrenceville. So if you guys do this and it's anywhere in the Duluth, or excuse me, not Duluth, but Gwinnett area, they are awesome. And then some of the next stuff I'm going to touch on is some of the, it may overlap with some of what Raymond's going to talk about with the way I set mine up. I set up a master LLC with my partner, and it became a partnership. And then every property I purchased after that, I put into an LLC all by itself, owned by the master LLC. So me and my partner don't own the properties personally. They're in the LLCs, which are owned by the master LLC. You know, it dilutes the risk on, not necessarily the risk, but the liability on many levels. And I'm sure Raymond will touch all over that. And then to make that work, from the legal side. You just have separate bank accounts. You do not commingle funds. And so if something were to happen at one of the properties, the liability is isolated to that one property. And, within those LLCs, you have separate operating agreements, separate EINs. You keep everything separate. It's its own entity, its own, it's its own company. And I know Raymond says he does all that. We do that too. It's a pretty simple process once you actually get it rolling. It's not that difficult. I think that's it as far as the actual setup of the businesses. And I know I was talking to Larry, and he mentioned talking about when you do quit claim the property into the LLC, that the mortgage company can call the loan. I think the lawyers and Raymond will give us all the advice we need on this, and they warn you of that. I have never ever had the issue. I've done it every single time, never had an issue. I even tell the mortgage people, they don't really care. As long as you're making the mortgage payment and making it timely, no questions will be asked. Those are the major topics. Do you guys have questions or have anything you'd like to touch on from what we discussed?
Hey, Philip, this is Cynthia. Thank you. I was quite interested about then your setup on the Master LLC. So we have an investing company called Reborn Homes LLC. What we do, it's most on the buy, renovate, and resell rather than hold for long terms. So if it's this case, and maybe it's a question then to both of you, then Philippe and Raymond from the CPA and the legal side, would you still recommend a structure like that and to put each of the investing houses, if you would, that are pretty much going to be there then from the moment that we purchase them, renovate them, resell them around 3 to 4 months? Is it really necessary to have a separate LLC for them in your perspective to manage risk?
Raymond, do you want me to answer that? Since it's so, I would do it. I would do it, because if you have, I don't know how many you have going on at one time, but if you have 3 going on at one time and there, something happens at one, then there is the possibility of it, commingling and going all over the place if something were to happen. And the other reason is the only other cost is actually of the setup of that LLC. It's not difficult because you got the master LLC, and then you got the other LLC that is owned by the master. I'm making the assumption that all your owners are going to be the same through every single project. Is that fair to assume?
Yeah, so I guess the reason why you put separate LLCs is so that if something were to happen in one home, and let's say somebody were to get hurt while they're then renovating the project or something, that they can only go up to then the amount that is insured for that property, that they wouldn't be able then to go across the other properties. Is that the reason for the managing the risk that way?
That's correct. Yeah. And, a big thing on my side, if you have it set up where you have the master and then you have the other LLCs, you're not requiring another tax return. So there's no other cost there. It's not like it's a single member LLC, which is considered a disregarded entity. So it goes straight on to that partnership tax return that you're already doing anyways. So the real big headache here is going to the bank and getting a separate bank account, keeping them separate, and setting up the LLC. It's not, and that's minimal, pros, cons. It's pretty minimal as far as cost and time.
So are you recommending, Philip, if you do, and I want to invite Raymond into this conversation, if you do have a master LLC and you have several LLC, you have an LLC for every other property that you're buying and holding or buying and flipping, you're going to have to, now my train just wrecked, you're going to have to, I know you said you're recommending a bank account for each of those LLCs underneath the master?
That's how you keep it perfect. That's, because if I were to look at your books and you've got one bank account for all those LLCs, I'm going to say, and from my understanding, the courts are going to say that's really one entity. It's just like if you have an LLC and you run all your personal things through there, I'm going to look at there and I'm going to say, hey, listen, this individual is the same as the entity. There's no difference. The code, you can put lipstick on this thing, but it's really the same thing. It's operating the same thing.
Okay,
The money's being spent there's no, it's never going to be perfect, but as close to perfect as you can get is where you want to be.
okay.
I have a question. So if you're using a mortgage, so you're not paying cash,
Mhm.
my understanding is most of the time, you're not gonna be able to get a mortgage in an LLC. You're gonna have to buy it personally, then change it into an LLC. Once you do that, will that negate your title insurance because it's a new owner, or because the ownership of the LLC are the exact same people that were on the mortgage? Will that keep my title insurance intact?
You're
You want me
going,
to answer that?
yeah, go
Yeah.
ahead.
If you transfer the title from an owner to an LLC, you're probably gonna, if you do a quick claim deed, you certainly lose your title insurance. So you either want to do an endorsement to the policy, get another policy, or at least do a limited warranty deed. It creates issues that you just need to have addressed when you transfer the title like that. But if you just quick claim it, the title companies could deny coverage.
Okay, all right, thank you. Now, is that the same thing if a husband quick claims to the wife and we're back and forth? Does that negate your title insurance?
No, because interfamily transfers like that are exempt from the due on sale provision, and that's not technically a default, and that's not gonna prevent anything.
I was hoping you would say that. Okay, thank you.
Is Raymond and Philip, is it true that you have trouble getting financing a property if you are in LLC versus an individual? Do you know?
Yeah,
Yeah, I'm here. Well, most lenders are going to require you to have a personal responsibility. So if you're doing a commercial transaction, typically it's going to close in the name of an entity, not your name personally, a corporation, S corp, or partnership, or a LLC, and they're going to require you to personally guarantee the loan. So that's how they get your hook on it, and they get your neck in the noose, so to speak. So rarely do you get a non-recourse loan. We do some big Fannie, Freddie Mac multifamily deals where they're non-recourse and there's no personal liability, but that's sort of a big animal and something that's sort of specialized.
Okay.
One thing, Philip, you might want to tell us about is what sort of haircut you get when you sell a property and you don't do a 1031, when you're talking about 28% long-term capital gain, state tax, municipal income tax. You might have your recapture, then you got your Obama ACA, penalty. If you're coming from New York or California, where there's a 13% state tax and maybe a 5% municipal tax, you're talking 50 to 52% tax rate on a property you sell if you don't do a 1031, correct?
Yeah, it depends on where you are. That is correct. The long-term rates for most people is 15% federal. And here in Georgia, 6%. That's going to be your average. And there's a little bit of difference. It'll go a little higher because of recapturing and depreciation, but that's a good starting point. But if you're in the higher tax bracket, where you're in the highest tax limits, long-term capital gains are 20%. And then you're going to add the Obamacare of 3.8. So you're at 23.8, and then Georgia gets you at 6. So you're at about 30% there here in Georgia. Yes, and you touched on California and New York. I know there's very high tax brackets, and I know some of the laws, but I wouldn't be able to tell you inside and out. But yeah, they're pretty high.
So we see people like selling a property in California and reinvesting here and doing a 1031 because of that very reason. I mean,
Yeah, absolutely.
they don't pay any tax on it versus close to 50%.
And they're talking
And the
about
1031 the 1031 exemption is a program is basically on the table with the president right now, and I don't think they're going to revoke it, but they're talking about doing that. I can't imagine them being able to pull that off.
however, they are talking about proposing an increase in the capital gains.
That's right.
And that might go from what is it currently, you said?
Either 15 or
28 to
20%.
38.
Yeah.
So from 15 to how much?
I have not read the the proposal. And to be honest with you, I am 10 days before the deadline, so I haven't touched on anything that's possibly new out there.
And we appreciate you being here.
Yeah, no, I know. I appreciate you
What's
guys
the
having
current,
me.
right? What's the current long-term capital gains rate?
15%, 20% if you're in the highest tax bracket.
So Raymond, I have a question for you. Philip was talking about the value of limiting your liability by creating a master LLC and multiple LLCs for multiple properties. What is the liability if you're just buying it as an individual? I think he's frozen.
So, Clark,
Yes.
I think about one thing that Philip said was, or no, that I think maybe Cynthia said, you know, you have a contractor in there and they're doing electrical or they're doing plumbing and the house burns down. You have a tenant in there and someone dies because a tree falls on the house. I mean, you could be talking about millions of dollars on a death case. So, you know, I think that obviously the LLC is one way to go. Another way, perhaps not as limited, is, you know, an umbrella, a multi-million-dollar umbrella policy on your personal if you're not doing an LLC. And
I do both.
Yeah, so there you go.
Okay.
Yeah, I agree with that. I do both just because they're both so easy to do.
Can you expand a little bit on that then, Philippe, on like the insurance piece? I know like for now, for instance, we insure in each home, but some investors and in our network, they're moving into the umbrella insurance piece. And then that would cover all of your property. So tell us a little bit about, you were mentioning that you do both.
Well, I have an insurance person. I'm not an insurance expert, but I do have an umbrella policy, which, you know, is on top of my, obviously all the other insurance that you have, life insurance, car insurance, house insurance, all that stuff. The umbrella policy just covers, you know, if someone were to slip and fall in my backyard or any other property that's in my name, you know, or I assume it may even cover you when you're in the car and something happens above and beyond car insurance.
Mine does. And so, for example, if you take the highest limits of personal and liability on your car, I don't know what it is now, probably $500,000. You have 3 people in your car and you have a fatality, you're talking about millions of dollars, right? So you take a $3 million, I don't know, you know, whatever you think, Philip, I don't know, you know, you can go as high as you want.
Right.
Umbrella.
It all depends on what you have.
Right. Umbrella policy. And if let's say you have a limits case, I used to do personal injury in a former life. So you have a limit case where the car accident is worth the limits of the policy, then your umbrella policy is going to kick in and cover, you know, under the right circumstances for the difference. So again, it's multi-use because it's for your car, but also if you're somebody, you know, you have a hazardous condition in a house that you are renting, and somebody gets seriously injured and it's above your insurance liability on the home, then it should kick in on that as well.
That is great. Thank you.
Out of curiosity, Philip, what does it cost you to keep opening up like LLCs?
But if you can do it yourself on the Georgia Secretary of State's website for $100.
Oh,
Now, if you don't know what you're doing, you should have someone do it. We charge $650 to do the. We first off, we pay the $100 for the $650, so the real cost is $550. We do everything. We get the LLC set up, articles of organization, certificate of organization. We get you an EIN number, and we do a very generic operating agreement. All things that will allow you to start business, take it to the bank, get a bank account open, and also apply for the EIN number, which you need to have a bank account. So from start to finish, we do that. And like I said earlier, is the great part about that is it's a single member LLC. It's an LLC as a member of the master. So there's no additional tax return due. You know, it's not like I'm setting this up for people to just charge them for another tax return. It's not, that is not the point at all. It goes within the tax return. So there's no additional fees on, on your accounting end or on your tax end. It's strictly liability. And, in my case, there's a one-time fee of $650. And then there's the annual renewal fee for the LLC of $50. Other than that, that's it. There's nothing else to keep up with.
But I will say, as Philip was saying, that you actually have to act like a corporation. So if you don't hold any meetings and you don't do anything, if you commingle funds, obviously, or anything, and don't act like a corporation, there's a legal doctrine that we will talk about, piercing the corporate veil. And if there actually is a big lawsuit, it probably wouldn't be hard to do if you weren't acting as a corporation.
Yeah, I think commingling the funds is really the thing that matters.
Agreed.
With me and my partner, we have two people. I mean, we may meet, but it's.
I got locked out. I'm sorry. My computer went down.
That's all right, Dr. Back. We can't see you, but we can hear you.
And we were talking about acting as a corporation and making sure that, you're be viewed as a corporation. Do you have anything to say about that? Obviously, we were talking about not commingling funds, but beyond that.
I have a question on commingling of funds. I have an LLC set up and just purchased my first flip property, and I took personal money to make that purchase, but I set it up as I don't know, technically, I guess a loan to the LLC. Does that constitute commingling of funds, or is it safe because it's basically a loan?
It's safe. You transfer the money to the LLC to make the purchase. Did I understand that correctly?
Correct, yes.
Yeah, that's absolutely right. Shareholder loan.
Okay, thanks.
I'm sorry, I got locked out for about three or 4 minutes, but I think when we talk about LLCs, and I don't know what I missed, but typically on most larger transactions, the lenders require the entity be a single asset, single purpose LLC that own no other real estate or have no other business other than the operation of that particular property. And we see a lot of that, and they don't want any linkage to other properties that could default this loan. So that's what we see most of the time. Now, we get smaller investors that may have a number of homes or a number of small rental properties. And that question made, Raymond, do I need a different LLC for each property? Well, it's sort of a personal issue because you're trying to insulate yourself from liability. And so certainly LLC can do that. As to whether or not you want to have a separate one for every home, you can probably accumulate a number of homes in one LLC and be okay from a liability standpoint. It's just how much do you want to have in one sort of asset pool that's at risk if one of your tenants got hurt and sued you and tried to come after all the assets of the LLC. So that's sort of the threshold question. But most of that is handled by insurance anyway. So that's what I tell people, so whatever's practical. And as Philip said, the LLC is very simple to set up. The filing fee is $200 to rush record it, which we recommend you do, because otherwise it takes you 2 or 3 weeks to get it back, and then you don't know if you got the name or not. And then operating agreement is, it just depends if you have more than one member and it's not your spouse. It's a good idea to have an operating agreement. You're required to have an operating agreement to see who has authority to do what. So it's a templated thing. We get into some pretty complicated ones, but for the most part, it's not terribly complex.
Yeah, you need one to open a bank account anyways.
Pardon?
You need one just to open a bank account. So.
Yeah, but like you say, if you have a single member or a husband and wife LLC, you don't need to get a separate EIN number.
Correct.
So you don't have to file a separate tax return. It just flows through to your bottom line, just like an S corp. So, it just protects, it affords you the protection that a corporation does without having to go through the logistics and the hassle of separating a separate tax return.
Is there any reason you would want to do an LLC versus an S corp?
Well, the LLCs are just more flexible. You can be very anonymous with an LLC. You don't have to have your name involved at all. and you can sort of do that with a corporation. There's some advantages, and Philip might be able to expound on that. If you are an S corp, you can have money flowing through there. You can pay yourself a monthly salary and deduct your or pay your self-employment tax on your salary, and then additional distributions can be deemed dividends, which you avoid paying self-employment tax on. So you can minimize your self-employment tax that way if you're like a self-employed attorney or CPA or realtor or something like that. So that's a tax strategy more so than a liability issue. But that's about the simplest way to do an S corp. But most every deal I see now in real estate is an LLC.
Yeah, and every company we set up is an LLC. If we make an S election to become an S corporation, you're still an LLC. You're always an LLC.
Right.
It's just the way you're being taxed. It's just the way you're being taxed by the IRS. So once an LLC, always an LLC. It's just how you're being taxed. That's the only difference. And as Raymond was started to say about the self-employment tax, that's really more relevant with, a professional business like, a lawyer, or CPA, or even a real estate agent that's 1099. Then you want to talk S corp, and you want me doing a W-2 to avoid all the SE tax. When you're just talking about investments, investment property that you're holding or even possibly flipping, and that's another story, because if you're flipping them, someone could see that as your active business. It could be subject to SE tax. So that's a much more in-depth conversation of making the S election. And there's a threshold on the amount of money you're making if you want to make the S election. So if there's anyone out there that's getting paid 1099 and you're an LLC, or even you're going straight to Schedule C, with just a sole proprietor, and you're paying all that SE tax, you really need to think about an S election to avoid all that SE tax, Social Security, Medicare, which is 15.3% you're paying on that before you even start paying federal and state taxes. But sticking strictly to the real estate side, if you're investing in properties and you're renting them out, chances are you probably don't want to go S corp. You want it to be a partnership because you want the flexibility that Raymond was talking about.
That's even for us as realtors, because we're automatically real estate professionals, right?
Yes. And the only thing that matters with a real estate professional is the number of hours you put in, which I'm sure all of you guys qualify. And then that allows you to take losses. That's the only real benefit.
It's active income.
Say it again.
It is active income. Even rentals,
yes.
right?
Active.
It's all active income.
Yes. Yeah. 99% of the time, yes. I mean, there's probably, depending on who your partners are and what percentage you have and certain things like that, we may be able to talk about not subjecting it to SE tax. But in general, that's a fair statement.
Do you deal much with self-directed IRAs, Philip?
Not much. No, I have, and I know, what's going on, but I don't deal with it a whole bunch.
Okay.
On the
Raymond-
investing and realtor, sorry, Clark.
No, go ahead, Cynthia.
On the investing and realtor income, if you would, Philippe. So we have our real estate active business, flipping business for the last 3 years. That's an LLC. And then now when I got my realtor license this year, I'm putting those commissions into that same LLC. Is that a concern, or would it be smarter than more than at the end of the day?
So who owns the LLC where you putting those funds in?
Myself and my husband were both equal partners into that LLC.
You file a partnership tax return?
We do it. We are taxed in as an S corp. So it goes in through our.
Okay, so you're an LLC being taxed as an S corp.
Correct.
Okay, yeah, you're perfect. Are you issuing yourself a W-2?
I think for this, we started doing that the last year because then we created a solo K also.
Yeah. It sounds like you're doing everything right. If you're an S corp, you're required to have a W-2 to be in compliance, because the whole point in an S corp is to avoid the Social Security and Medicare tax.
Mm-hmm.
And that's why the IRS requires you to issue a W-2 from the company to you personally. And you keep that W-2 as low as possible to avoid the SE tax. But you can also make a judgment call on where you want it to be based on your retirement needs and wants that you started to mention.
Excellent. Thanks.
So Raymond, question for you. What other pitfalls do you try to help? Let's say somebody's doing their first investment or their second, or maybe they're branching out into some other type of income producing property. What are some basic pitfalls that you advise people to try to avoid?
Can you be a little more specific? Not sure exactly.
Well, let's say,
Just like a
let's say title insurance. Does everybody have to get, like, if I'm paying cash, are you always going to advise, or is it what about title?
Okay, so I see what you're talking about. Okay, so title insurance is has gotten fairly expensive, and we occasionally get somebody that buys a property and says, "I'm not buying title insurance." So we make them sign a waiver because we feel like there's exposure involved with that. And the downside is it's like having a house without insurance. If it burns down, it's not going to burn down. It's probably not going to burn down. But if it burned down and you don't have insurance, you got a big problem. And the same thing is with title insurance. We don't expect you to have a title problem, but if you do and you don't have title insurance, you got a really big problem because it's expensive. I had a friend buy a house about $1.2 million over in Virginia Highlands. He bought title insurance, but he didn't get a survey. Because he didn't get a survey, he didn't have a survey exception. He went to sell it a couple of years later, and there's a big sewer line going right under his house. So it's undisclosed. It's been there for 100 years, but the buyer did a survey and discovered the sewer line, and it cost him about $75,000 to get it resolved. So surveys, especially in older areas of town, and if it's not a platted subdivision that's in the last 20 or 30 years, I'd get a survey. Anything in town, anything up on the lakes, I always buy title insurance and non-recurring expense. It's not as inexpensive as it used to be, but it's just a one-time thing you have to buy. Now, if you're going to flip something immediately, we don't ever do any flips over here, but I know they happen. But if you're going to hold it for a very short period of time, that's a risk you may or may not want to take. It's just, you understand that your risk is all your equity in the deal. And so if you're paying cash, you're just absolutely naked without title insurance. So, if you're loaded up on debt, you got less of a margin, but you got less exposure than if it's a cash deal. So we always recommend to do that. We always recommend that you get, a very thorough inspection and that you always get it surveyed, especially like commercial properties. Most lenders require, like if you're doing a subdivision, like a shopping center, or if you're doing like an office park, or if you're doing a multifamily, they require survey coverage. So we have to go get a survey, and they're not inexpensive. Now, sometimes we're able to have a owner seller opine that the survey they have that's like 8 years old is still valid, and there's been no changes to it. So we get, they call a no change affidavit signed by the seller, and we're able to afford the lender and the buyer survey coverage on that survey without having to go spend $5,000 on the survey. But that's the biggest pitfalls, is trying to cut corners where you really don't need to cut corners.
As an investor, I would 100% agree, even on a flip, than to put title insurance. It saved us big time on a deal. It wasn't just, a $200K investment, but we put in then about $50K, then to renovate it. And then everything was good and on the buy side, but then in the middle, 1 week for finishing the rehab, here comes a lady and she's saying, well, this property was from my husband. We bought it from the son, but son and dad had the same name. It didn't come through at all. And things that we had in title insurance, everything went cleared up. And you just never know those cases. So it's better not to cut corners. That's what we've learned.
Most of the title claims aren't that there's a forged deed in the chain of title, or there's some sort of title defect based on a boundary. It's usually, or that somebody that handled the transaction back in the last 30 or 40 years made a mistake. They did something wrong, or they missed something. And, there's taxes that don't get paid, or there's judgments that don't get picked up, and there's liens that don't get picked up. And then you inherit them. And your recourse, of course, is back against the lawyer that closed the transaction, against the seller, but you still got to get it done. And so, you know, you just can't be careful enough because it's a high liability issue.
Okay, I have a question. Can the host of this Zoom call ask a dumb question? He's gonna anyway. So Raymond, I remember when I bought my own personal home, and my compliance broker, who is also on the call, Alita, said, I asked her at the time, I said, should I get a survey? And she was like, yes, yes, and yes. And so I was very dutiful and got a survey. But what other step do you have to take? And let's apply it to an investment side. Just by getting a survey and looking at it, then what? I mean, just because you have a survey, then do you have to give it to the how do you connect the dots there? I guess is what I'm trying to ask.
Well, the survey is supposed to reveal everything that's on the property, you know, all the easements, all the access, you know, you got power lines and access easements and curb cuts and locations of the improvements and all that. So it depends on the extent of the property itself. So it just ensures that if something's there that should have been picked up by the surveyor or the title person, the title company is gonna pay you whatever your loss is on it. So, and so that's kind of the thing. Now, on a residence, the title companies about 25 years ago started insuring the lenders, and then eventually they started insuring the buyers for a residence for survey matters without getting a survey. And so that's why a lot of people don't get surveys, but that only qualified, you can only do that if the property is in it's like a platted subdivision, you know, and it's not something that's just a piece of property up on Lake Lanier or some, you know, property down in Buckhead that's been there for 100 years, it's been changed 6 times. So for the most part, I'd say 90% of our residential properties we close on fit that criteria, but still people get a fair amount of surveys, maybe 25% now. But most people have gone away from getting a survey on a resident. But I'd say on a commercial property, it's probably a good idea to get the survey, or at least get survey coverage on your title policy by having an older survey, you know, coverage, that kind of thing.
And I'll tell you a situation that just came up recently where an investor purchased a property. The seller had a copy of a survey. They did not attach the survey to the contract, which means, you know, if you attach it and then you get a new survey and it's materially different, you have an issue, okay? But they didn't attach it.
Right.
They did not buy a new survey. And then later she bought a new survey and saw that the setbacks were actually quite different than the original survey, and actually prohibited her from doing what she wanted to build on the property. So I agree that, you know, it's worthwhile, certainly, if you're going to be doing construction and stuff like that, to get a survey. And now also, don't forget, we have that, when I'm still calling new, but it's not so new anymore, the 75-foot stream buffer and all that, which could prohibit even putting a deck on and stuff like that without variances. So I think it's still important.
Exactly.
Okay. Who has a question for Raymond? Y'all, this is free legal advice.
Worth what it costs. Any questions?
If you're here's my question, Raymond. If somebody on the call is just starting out, doing their first deal, maybe they just purchased, or they just put their first property resale under contract. If somebody's just starting in the business, anything you would share for newbies, just a general advice for a new investor?
Well, you know, it's a financial deal here, and they want to be able to be realistic about what the finances, you know, what this property is going to generate in revenue, what's going to be their cash flow. Are they going to be underwater? Are they going to be? I saw a lot of people get underwater on investments, you know, 10 or 12 years ago, because they were just buying property blindly. So, you know, we do, again, a lot of multifamilies, and a lot of the due diligence goes into looking at the rent rolls and the cash flow and the occupancy rate and the loss rate and, operating costs to make sure that you know what your investment is. Because like you could screw it up most of real estate deals, and eventually over time it'll correct itself and you'll come out okay. But you really, the more due diligence you do on the financial side of it, the better. And especially somebody trying to get in the first time, because they probably don't have a tremendous amount of money. This may be a big step for them and they want to have a good experience and build off of it, because you buy one, then you can buy another, or you can do 1031s, etc. So look at the financial end of it. Talk to somebody who's done a lot of them and made sure that they're not missing anything. So look at the financial stuff. We have on most of our multifamily stuff, we have about a 2-page list of items we request to seller to provide the buyer when we go into contract within a few days. And of course, it's way over inclusive, but we ask them to give you what you have. So you've got loss reports on insurance, tax returns, cash flow, survey, title insurance, surveys, just anything and everything, any kind of contracts associated with it, operating costs, utilities. So, they can kind of get a realistic idea of what it costs to operate this property versus what kind of money they're gonna make out of it. But it's a tremendous way to build wealth, is to buy and invest in real estate. Because again, like Philip says, you depreciate it, so it offsets your taxes. I mean, these guys, I got a doctor that's been investing with one of my other clients, and they got a lot of real estate, millions of dollars, and he's writing off, a couple $100,000 a year in depreciation against his income. He's a cardiologist. So, it's a tremendous vehicle for him to defer or avoid paying tax. At the same time, he's got very little skin in the deal, so it's a great vehicle.
I have a question. I heard that somewhere else, and I was wondering if I got your opinion on that. So the claim was, if you do a lease option or a lease purchase, and I don't know if it was one or the other or both, that the person who during the lease term has an equitable interest in title, and therefore it might be difficult to evict them if they don't pay their rent. Can you comment on that?
They have a claim, but it's not a recorded claim unless they record their lease purchase or their lease option. We see option agreements recorded occasionally mostly on land, when somebody wants to take an option on a piece of property while they're checking out the zoning and see if they're going to build a warehouse or redevelop it to a subdivision, something like that. So those things have to be cleared. But most option, lease purchase agreements, I try to tell people to stay away from, because that person that's buying the property, they buy it if they had the money, but they can't buy it money, so they're going to lease it until they can afford to buy it. And by the time they get around to buying it, they may not decide to buy it anymore. So I don't like that concept of a lease purchase on a deal. An option's a different matter.
Well, some investors actually like it because, if they default, they can get to keep the option payment and just put a new tenant in there. But yeah, it's risky.
I don't disagree with you. I don't disagree, but it seems like the tenants, it's a sort of a, I'd rather just lease it to them, and if they want to buy it, then they can buy it. I don't know if I'd give them any rights, but that's something that we occasionally see, but it's sort of a messy thing. The tenant tends to learn everything about the property, and they'll start negotiating with the owner about, we want X amount of credit for the rent that we paid over the last 2 years toward our down payment, or maybe that's the way they get their down payment. It's just a case by case basis, but it's not I don't think a great vehicle to handle things.
So I've got a question for you, Raymond, and then we're gonna ask if there are any others and sign off here, because I'm gonna be a good steward of y'all's time. We got about 4 or 5 minutes left. Are y'all following I noticed in today's online that a federal judge struck down the moratorium on renters getting evicted.
I saw that, and it's a DC district judge issued an order that the CDC does not have authority to impose a moratorium nationally on evictions. That was the extent of it, and so I'm sure it's going to be appealed. But they're saying whether or not, again, the CDC can do that.
I think it
There
was
is a standing-
appealed, actually. It was appealed and they stayed the order. So like, then they stayed it, right? So then now it's pending appeal to just, to make the determination if they can actually do it.
It's like these district judges, they can impose a nationwide moratorium unilaterally, like on the immigration stuff or tax things that really caused a problem, I think, politically, but nonetheless, there is a standing moratorium by executive order for any foreclosures or evictions on real estate. It's been going on if it's a Fannie, Freddie, FHA, VA, any kind of government-backed loan. So there's no foreclosures. We got a foreclosure department. They've gotten really good at playing cards in the last year because they hadn't foreclosed anything in a long. I don't know what they're doing, but they don't come to work a lot. You know?
Sign me up.
So I think this will be in the news, but I don't think it's had much of an impact because nobody's getting evicted anyway right now.
Are they still looking to lift the moratorium on mortgagees when, in June or something? Is that what the timeline was?
I think it's like June. I think the current one is up at the end of this month. I think June 1st, but I may be wrong. But that's the can they'll keep kicking down the road, you know, and you can evict somebody if they're not living there. If they've abandoned the property, you can foreclose them. Or if they've moved out, you can evict them. But if they're in residence, you can't do either right now.
Oh, wow. Okay, that's good advice. All right, y'all, any
Yeah.
last questions or ahas? Unmute yourself and share with us if you learned something that was useful today.
Our firm does mostly residential, but I do all the firms, most of the firms, commercial work. So, you know, I know you guys got a good commercial practice over there, and we'll help you guys anytime we can with responsive. And we got 3 or 4 really good commercial paralegals that, you know, they do all the heavy lifting. So they do a great job. We
Awesome.
appreciate it.
Thank you, Raymond.
Philip, good here.
Quick one. I think we were talking earlier about then purchasing a property on your name or then on your LLC. And usually we buy them in our LLC, our active business. When it comes to requesting permits from the city, we always use then licensed contractors. But of course, with the permits in the city, then you need to get in your licensed contractor and it takes time. One of the recent advices we were told is just buy it under your name and then it's much quicker to get permits from the city. Would you then recommend that, or is there any legal repercussion of buying a property on your name versus on your active LLC?
But you buy it in your name and then put it in LLC? Is that what
I
you're
guess you buy it
saying?
in your name, so that you can then have then a quicker resolution in getting then permits through the city to do the work of rehabbing that investment property.
No, I don't think so. They typically won't call the loan due. I had a property in Athens, Georgia that I owned, and we took it from our names individually and put it in the LLC. And I had a line of credit on there. So the bank called me like 4 months later and goes, you know, y'all don't own the property. I said, no, we own it. We just put it in the LLC. What they did, they said, okay, we'll let that go. But they froze the line of credit. They wouldn't give us any more money on the line of credit, which was okay for us because we wouldn't really want to use it anyway. But that's what they can do. They won't take the property back, you know, unless you're in default, you're not paying it typically.
What I hear her saying though, Raymond, and maybe some others can chime in on this, is that you get permits issued more quickly if you're an individual versus an LLC. Is that correct? Is that what you're?
Hey, I don't think that has anything to do with it. I really don't. I think the biggest problem you got with the permitting is the pandemic, and Fulton County, City of Atlanta, wherever you're dealing with, getting a permit is a real. I mean, they're people that's their expediters. That's all they do is you hire them to go down there and get your permitting done because you got better things to do than spend all day downtown.
I love
And,
it. That's
it's not-
leverage.
Thank you.
Who else has a final comment and that they'd like to share? Tell us something you learned today. Come on. An aha. Alita, you must have learned something.
Yeah, well, I thought it was excellent information, just all around, just, you know, from incorporating to protections and everything down the line. So really appreciate it.
Awesome. Well, y'all, I just want to say thank you. Raymond, Philip, thank you so very much. We have y'all's contact information. I hope that we get you some business. You guys reach out to these gentlemen when you need them. And maybe we can do this again sometime in the future. And Philip, good luck with all your timelines.
I appreciate it. Back at it now.
All right. Raymond, thank you. Go ahead.
Thank you very much. We'd like to, I'd like to get, we've had a lady that does all our 1031s, and she's with one of the title companies, and she's a wizard at it, and she's really good, and she has got a great feel for being able to talk to a crowd of people and tell them how this 1031 can work on a smaller scale versus a really big scale for people that are buying a property, they want to reinvest in their beach property, and next thing you know, they just avoid all kind of tax. So she does a really good job, so we should do that sometime.
You got a deal. I'll be in touch.
All right. Well,
Thank you,
thank you all
everyone.
so much for our time. Great
Thank
job,
you
Phil.
all.
Thank you.
Appreciate it.